What if I told you that every single candle on your chart is telling you a story? Not random noise, not just price going up or down, a story written by the biggest players in the market. Welcome to SMC Module 3. In this module, we're cracking the code on candlestick charts through the lens of smart money concepts. By the time we're done, you'll never look at a chart the same way again. We're covering 6 things today: what candlesticks really mean, bullish versus bearish, candles and context, wick manipulation, and this one is huge: impulsive versus corrective moves, why you need to ditch your indicators, and how to set up your charts like a pro. Let's get into it. Every candle on your chart shows you 4 things: the open, where price started; the high, the highest point reached; the low, the lowest point; and the close, where price ended. The thick rectangular part is called the body. Green or white body, price closed higher than it opened, buyers won. Red or black body, price closed lower, sellers won. Then you've got the wicks, those thin lines sticking out from the top and bottom. The upper wick shows prices that were reached but rejected. The lower wick shows the same thing on the downside, and this is where most traders completely miss the point. They see a green candle and think, oh, buy signal. They see a red candle and think, oh, sell signal. But from a smart money perspective, we ask deeper questions. Why did price move there? Who moved it? What liquidity did it grab? What does it mean for the next move? Because here's the truth: institutions are not moving price randomly. They're hunting your stops, building positions, and leaving footprints, and those footprints show up on your candlestick chart. Now let's talk about strong versus weak candles, because not all bullish candles are created equal. A strong bullish candle has a big body with tiny or no wicks. That means buyers dominated the entire period. No real pushback. This is what institutional buying looks like. They came in hard, they stayed in control. A weak bullish candle, small body, big wicks. Buyers technically won, but it was a fight. There was resistance. Same logic applies to bearish candles. Big body, small wicks. Institutions were selling aggressively. Small body, big wicks. Sellers barely held on. But here's the key insight, and this is where retail traders get destroyed. A bullish candle at resistance is not a buy signal. It's often a trap. Think about it. Institutions need sellers to sell into. If price pushes into a resistance area with a big green candle, retail traders get excited and buy. And institutions, they're selling into that buying pressure, distributing their positions. A bearish candle at obvious support, same deal. It's often a liquidity grab. Retail traders panic and sell. Institutions buy from them at a discount. Context is everything. It's not about the candle color. It's about where that candle is forming and what happened before it. Okay, this is the section that's going to make you rethink everything. Wicks, manipulation, let's go. Wicks are the most important feature on a candle for smart money traders, not the body, the wick. And here's why. Wicks show you where liquidity was grabbed, where institutions hunted stops, where the manipulation happened before the real move began. Let me walk you through 3 manipulation tactics that institutions use. And you'll start seeing these everywhere once you know what to look for. Tactic number 1, the stop hunt. Imagine there's clear support at 1.0800 on euro dollar. Every retail trader watching that level has their stop loss just below it, maybe at 1.0795. What do institutions do? They push price below that level down to 1.0788, triggering all those stops. Retail traders get stopped out. Institutions buy from their panic, selling at a discount. Then price rockets back up above 1.0800. The only evidence? A wick, a beautiful long lower wick that says, yeah, we were here, we grabbed liquidity, and we reversed. Tactic number 2, the false breakout. Resistance sits at 1.0900. Retail traders are watching for a breakout above that level. Price spikes to 1.0915. They breakout confirmed, right? Retail piles in long, wrong. Price immediately collapses back below 1.0900 and closes at 1.0880. Retail is trapped in a losing long position. Institutions sold into all that breakout buying. The wick to 1.0915, that's your evidence. The manipulation happened there. So tactic number 3, the double wick. This one is sneaky, and most traders never even notice it. A double wick candle has a long wick on both the top and the bottom with a small body sitting right in the middle. It looks like price couldn't make up its mind. But here's what actually happened. Institutions grabbed liquidity on both sides. They pushed price up to trigger the stop losses of short sellers above the high. Then they pushed price down to trigger the stop losses of long traders below the low. Both sides got hunted in the same candle. What comes next is usually explosive because once all that liquidity has been collected from both directions, institutions have everything they need to commit to one side. The next candle, or the next few candles, will reveal which way they chose. So when you see a double wick candle forming at a key level, don't ignore it. Don't trade it immediately either. Wait, watch the next candle. That's your directional confirmation, and it often launches the biggest moves on the chart. So how do you trade wick manipulation? Simple 4-step process. Step 1, identify obvious levels where retail stops cluster, previous highs and lows. Step 2, watch for wicks that spike beyond those levels. Step 3, confirm the rejection. Price needs to close back beyond the level. Step 4, enter in the direction of the rejection with your stop placed beyond the wick. Remember, the longer the wick, the stronger the rejection, and wicks at key liquidity zones are the most reliable setups you'll ever find. Here's a concept that separates the traders who consistently profit from the ones who constantly get stopped out. Understanding the difference between impulsive and corrective moves. An impulsive move is a strong, fast, directional push driven by institutional order flow. Think big-bodied candles moving in the same direction, minimal wicks breaking through levels quickly. This is institutions aggressively buying or selling. A corrective move is the opposite. Small, choppy, overlapping candles that drift against the impulse direction, slower, messier. This is retail traders taking profits, fighting the trend. Institutions are mostly sitting this part out. Markets move in waves, impulse correction, and once you see this pattern, you'll see it on every chart, every time frame. Here's why this is critical for your trading. The worst thing you can do is chase an impulsive move. You buy the top of a big green candle and then the correction hits and you're immediately in the red, panicking. The right approach, wait for the correction to bring price back to a key zone, an order block, a fair value gap, a discount area. That's where institutions are waiting to enter again. That's where you want to enter. Enter during corrections, profit during impulses. Like, okay, I need to talk about something. And if this is you right now, don't worry. We've all been here. If your chart is covered in RSI, MACD, stochastic, Bollinger Bands, and 3 different moving averages, we need to have a talk. Here's the problem with indicators. RSI, MACD, moving averages, they are all calculated from price. They're showing you what already happened. They're lagging. By the time a signal fires, the move is often already done. And worse, everyone sees the same signals. Retail traders, bots, everyone. Institutions know where the 50 moving average is. They know where the 200 moving average is, and they use those levels to trap people. And the smart money philosophy is this: price shows you everything. The candlestick is the indicator. You don't need anything on top of it to read institutional behavior. You just need to know what to look for. A clean smart money chart has candlesticks, key swing levels marked, order blocks highlighted, and fair value gaps boxed. That's it. And here's what that clarity gives you. When a retail trader sees RSI oversold, MACD bearish, price at support, and moving average resistance all saying different things, they freeze. An SMC trader sees liquidity grab below support, bullish order block, structure intact, discount zone, clear signal, they take the trade. Less is more, always. Here's how to clean your charts right now. Week 1, Remove all indicators. Yes, all of them, including your favorites. Trust the process. Week 2, add back only what you need. Key swing levels and order block zones. Month 1, trade with clean charts. Notice how much clearer your thinking becomes. You won't go back, I promise. Let me show you exactly how to set up your charts for smart money trading. You're going to use multiple time frames, and each one has a specific job. Your daily and weekly charts give you the big picture. What's the overall structure? Is this market bullish or bearish? Where are the major zones? Your 4-hour chart is where you find your key order blocks and fair value gaps, the zones where you'll be looking to enter. Your 1 hour and 15-minute charts give you precision. This is where you confirm entries, watch for liquidity grabs, and time your execution. Candlestick charts only. Never Heikinashi, never Renko. Those smooth out price action and hide the wicks you need to see. For colors, high contrast. Green bullish candles, red bearish candles, dark background. You'll be staring at these charts for hours. Make it comfortable. Your daily routine looks like this. In the morning, spend 30 minutes checking daily structure, marking new order blocks, noting any overnight liquidity grabs, and setting alerts for key levels. During the day, wait for those alerts, then drop to lower time frames to confirm your setups before taking them. In the evening, spend 15 minutes reviewing your trades, updating your chart markings, and planning tomorrow's key levels. Your chart setup should make trading easier, not harder. If you feel overwhelmed looking at your charts, that's not skill. That's clutter. Simplify. All right, let's recap. Module 3 in a nutshell. Candlesticks tell the institutional story through open, high, low, and close. Candle color alone means nothing. Context is everything. Wicks reveal liquidity grabs and manipulation, the most powerful signal in smart money trading. Impulsive moves show institutional participation. Corrective moves are your entry opportunity. Clean charts without indicators reveal what cluttered charts hide. And multi-time frame analysis, daily for bias, 4-hour for zones, 1 hour and 15-minute for entries. If you take one thing from this video, let it be this. Stop fighting the market. Start following the footprints that institutions leave behind on every single candle. Now your homework. Open any chart right now. Find one wick that looks like a stop hunt. Ask yourself who benefited from that move. That's how you start thinking like smart money. If this video gave you value, smash that like button, subscribe if you're not already, and drop a comment below. What was your biggest takeaway? In Module 4, we're going deeper into market structure. How to identify trend, spot structure breaks, and recognize when institutions are switching direction. That's where the real edge begins. See you in Module 4.